Markets don't turn on data, they turn on confidence. One whisper of falling rates, one signal of stability, and suddenly the crowd believes again. Right now, the numbers say calm, cautious, subdued. But the undercurrent tells another story. Most people look at house prices and see numbers. Nukuru sees psychology, the patterns, the hidden levers.
Financial freedom faster. Financial freedom faster.
If you're waiting for the perfect moment, you've already missed it. The market doesn't wait, it moves. The Mortgage HQ Snapshot isn't polite, it's a slap in the face. The kind that wakes you up, gets you off the fence and into the game. Take the shortcut, it's direct, it's sharp, and it's sitting in the description. Nick, how will the direction of the official cash rate shape property investment decisions in New Zealand?
Yeah, look, the official cash rate being dropped a couple of weeks ago, and not just the drop itself, but the forecasted drop of 2 more cuts to come before the year's out. That's really been the thing that's interested any market commentators. It is a sign that the Reserve Bank has lost a bit of patience with the economy and that it hasn't really responded to previous monetary policy loosening. And so it's designed to kickstart our economy. And as the flow usually goes, once the economy starts to improve, we'll likely see increased activity in the property market and likely some upward price pressure as well.
And what impact will inflation trends have on the mortgage rates and investor strategies?
Yeah, right now that's the key thing the Reserve Bank is looking for. They have acknowledged there is some upside risk to where inflation could go to due to global political uncertainty and the tariffs, of course, coming from America. What they have been very clear about, though, is that they are looking through, as they call it, the short-term volatility and short-term upside risk of increased inflation. And as long as it stays near the top end of their expected band of 1% to 3% inflation, then they feel comfortable to continue to cut the OCR to provide the economy support that's required. So as long as that inflation doesn't jump outside the band and is, unexpected from their perspective and being higher than they otherwise think over the medium term, then they feel confident to be able to provide those cuts, which, as I said, should boost the economic activity here in New Zealand.
And are the lending conditions cautious at the moment, or are banks looking to help the RBNZ stimulate the economy as well?
Yeah, I think from the bank's perspective, they're ready and willing to lend out money. It's a relatively competitive landscape out there where they are still willing to give cashbacks where required. They're pretty competitive on their rates. We're still seeing, mostly every couple of days rates are coming down since the last official cash rate decision. So they are pretty open and willing to lending. They do have some room to move within all of their speed limits, whether it's the loan to value ratio rules, the debt to income ratios. They've got room to move there as well. So it's really about just that being married up with the confidence from those potential buyers who, really just need a boost to come from the economy and from the job market, people to feel comfortable in their jobs, to feel like the next conversation is going to be hopefully a pay rise rather than a pay cut. And that'll get them back out there transacting in our economy, and that flows through to the property market too.
And what significance does it have with most mortgages repricing and interest rates coming down over the next 12 months?
Yeah, look, there's still a large number of people who are coming to refix their mortgage over the next 6 months, as well as the next 12 months. It's almost 40% in the next 6 months. So there's a large chunk of people, going to refix their mortgage in the next 6 months. For the majority of those, they are likely to be refixing to a lower interest rate. And this is the whole idea of monetary policy. And this is why there is a lag. But as we do adjust down to lower interest rates, the idea is that it reduces your mortgage payment size. That means you've got more disposable income. And theoretically, you should go and spend that disposable income in our broader economy, whether that's going out for dinner more, having some local holidays, or going and buying a big ticket item like a car or a household item. So that's the expected response. I think the one thing that's holding that back right now, because we've been seeing people adjust to lower rates already, is the fact that some people are keeping their mortgage payment the same level. So they're getting ahead on their mortgage payments to some degree, or the extra money that they're saving from their mortgage payment being lower, they're actually shifting that towards, their other expenses they're having to pay for, whether it's their food bill or their gas bill, these things that are actually going up over time, their insurance. They're not really being able to spend that into the disposable economy. And that's really holding the economy back right now.
And what do you make of first-time buyers? The near record market share for first-time buyers, right?
Yeah, that's right. Yeah, in the latest month of data we got for July, we saw 27.2% of sales were to first home buyers. That is at near record highs. Look, first home buyers, the motivation doesn't change for them, right? They're getting into a market where they're buying a roof over their head. There's an emotional value to that. They're hopefully most often looking to own, buy and long and hold long term. And so they're looking at potential long-term growth in the market. They're also knowing they're going to increase their equity over time if they're on a principal and interest mortgage payment. They're exiting a relatively unaffordable rental market, so there's some appeal to that as well. These motivators don't change for first-home buyers. So if they can find a way in, they will certainly take that opportunity. So it's all about, can they get the deposit? Can they afford the mortgage right now, which as prices haven't gone anywhere and mortgage rates have come down, they can afford to borrow more. And then just do they feel comfortable in their job, which for, obviously many first home buyers or potential first home buyers, they're doing okay. And so they're finding the way to get into that market. And so we're seeing their activity hold up relatively well. And really they're benefiting from the challenges that are affecting the other buyers, which are seeing them be less active than they otherwise might be if the economy was doing a bit better right now.
And is it fair to say that investors have kind of ridden through this tough period the last 5 years with the high interest rates, the interest deductibility rule changes, bright line changes, and now there hasn't actually been an investor sell-off? They've got through this tough period and now investors are starting to get back in the game?
Yeah, I think that is the case. We haven't seen investors getting out of the market to any great degree. There's no doubt there'll be people out there that will have, divested out of the market and taken some properties that might have been costing them a significant, cash flow negative. So they're having to top that up every week. Some of them will have exited and got out of it while they could. But now we are seeing some of those investors, those property owners come back to market, many with small portfolios of sort of 2 to 4 total properties, who must be finding some opportunity out there, some value, looking long term, just like those first home buyers are, knowing if they're paying off their mortgage over time, increasing equity, and they're hopefully looking to that, their retirement time and wanting some form of passive income and all the things that we know property can provide for people if they haven't got a strong or large stream of income coming their way, that if you can find a way to leverage to get into the property market, those long-term benefits are still there. Now, it doesn't look like that demand is anywhere near as strong as it has been in the past, but the increased level of activity to those smaller investors is certainly showing that some are out there finding value. They've no doubt heard plenty of positive stories from their family, friends over the last, 10, 20 years, whatever it would be. They've probably owned their property for 10 or 20 years. They've seen their equity increase. They can now leverage that to get into the market. So, look, there's still pockets of this happening, but we do have to acknowledge it's not quite the same levels as what we've seen, at many stages over the past decade, and certainly not through those COVID periods where money was very cheap, very available, and many investors filled their boots through that time as well.
Well, looking at the consents level, the level of consents being granted, what are your projections for the next 3 years and into the future? We're going to have this extra supply and consents are picking back up?
Yeah, I think the key thing with the construction sector and then those consents, which is an intention to build, right? We have seen that number basically flatten out over the last 12 months in terms of the annual number of consents being issued. Now, that is at a much lower level. It's around 33 to 34,000 consents per year, well down on the peak, which was 51,000 a few years ago. And you look at that and go, that's a significant tightening of that construction sector. But when you look into a further historical context, following the global financial crisis, consents got down to as little as 11,000 per year. So we haven't seen the tight contraction now of the construction industry as we have back then. No doubt we've lost some builders who might have moved to Australia and people that are in that construction sector. So there has been a tightening up of that, but it hasn't dropped to crazy levels, right? And we think sustainable levels of consenting and building in New Zealand is around about that 35 to 40,000 per year. So we're only just below that. Now, my expectation for consents is that we will see it continue to be relatively flat for the next wee while. That could be maybe another year or so. My expectation is that once the economy starts to grow, and that could be within the next 6 months or so, as long as it goes according to the Reserve Bank's hopes and plans, as well as the government's, then you might see the construction activity start to lift on a 6 to 9 month lag from the rest of the economy. So if we see growth this year in the economy, then maybe in the second half of next year, will we see consents actually start to lift. But there is a strong pipeline there of work still being completed. As you said, that's increasing levels of supply. And that is one thing that will, with that choice for first home buyers, for other buyers out there, it's meaning there's not that desperation for the prices they're paying. And that's why we've essentially seen values be flat over the last 2 years or so.
And migration and employment trends, how are they tracking along and impacting the rental markets?
Yeah, migration has reduced significantly, but the way people talk about it, you'd think they were actually in net negative migration. We're still not. We're still gaining more people than we're losing. It is down on historic highs and certainly even historic averages. We're sitting around about that sort of 20,000 net new migrants coming into the country. So that's total of those coming in minus those leaving. Um, so that means the demand for rental property is still there, but again, it's not as strong as it was a couple of years ago when there was, upwards of 100,000 net new migrants coming into the country, requiring a roof over their head, whether that's buying or renting. So that's just meaning that demand for rental properties, because we know many of these people go into the rental market first, is not as strong as it usually is or has been in the past. And so there's not that same desperation in the rental market. Rental supply is still relatively high as well. So the choices are there, not just for buyers out there, but for tenants trying to look for a property for renters. And so again, we're just seeing this, lead to not much growth in the rental market. In fact, in some of the main centres, particularly Auckland and Wellington, we're seeing rents decline year on year as that balance is firmly sitting more on the supply side than demand. And that's also a factor because we're not seeing household creation happen as much. We're not seeing people move out of, say, larger flats where there might be 4 or 5 people and going and living 2 people to a house, because they simply can't afford it given the cost of living and some of the cost of rent around some places too. So we're just seeing a restricted level of rental growth there because we're not seeing that demand at levels that we've seen in the past.
And how should investors be positioning themselves given this economic crossroads? Now, I noticed from the latest report the total amount of interest-only lending has been trending down. The amount of borrowing banks are doing it at that high threshold has dropped. There seems to be a lot of room left for growth in terms of borrowing, and investors can take that up.
Yeah, look, I think it's available there. There's no doubt that there's been a tightening of the type of lending that's been done over the last, say, 5 years. That has protected the housing market, if you want to see it that way, from a greater fall if the lending wasn't quite as tight as it has been. Things like the triple CFA standards, as you said, those restrictions around LVRs, which have been in place for more than 10 years now, debt to income restrictions there. There is room to move on these things. Now the question is it a point, is it a thing about people being willing or able to get that borrowing? Now, as interest rates are declining, people can borrow more compared to their income, but maybe they're not so willing to do so because they know that the market doesn't only go one way. And so they're being relatively cautious in their own activity in terms of how much they're willing to borrow, whether that's from a first home buyer perspective, an owner-occupier perspective, or an investor's perspective. We know there's just a little bit more cautiousness out there. If you do your sums and you know exactly what you can afford to pay back, you've got your projections of what future growth might come through. And my suggestion is always to pick a future growth rate that's lower than what we've seen in the past. You can make that work for you, and you're obviously good at maybe finding a bargain in terms of the value you're going to pay for a property, maybe the work that's required, where you can increase the rent and what rent you can gain on that, plus the associated costs of owning that property and renting that property out aren't too great in terms of insurances and rates and things. Then you can find some opportunity here. So it's really about doing that due diligence, knowing your numbers, having sensible projections, and then obviously talking to the bank or a broker and really understanding what your financial position is to be able to maximize your position based on the properties that you can find as well.
Nick Goodall, Cotality, appreciate your insights today and look forward to catching up again soon.
Always good to chat. Appreciate it, Andrew. Thanks, mate.
You want ammunition, moves that work, tactics that win? The 3 property formula is the playbook smart Kiwis are already using, while the rest are still refreshing Trade Me and panicking at interest rates. No fluff, no webinars, just results from the front lines. Get the strategy and own the edge. Grab the book before someone else buys your future.